Some experts believe that the United States might be in an economic bubble, and one of these experts is well-known investor Jeremy Grantham. He thinks the current bubble is on the verge of popping and might lead to a severe economic decline. Join us in today's video as we hear Jeremy Grantham's analysis of this situation.
So a great history of calling these major inflection points. What would you say is the next one? And do you feel like we're in a bubble today, kind of like what we saw in the late 90s with the tech bubble?
I do think we're in a bubble, but I also think it's unlike any other bubble. The great bubbles of history, whether it's the South Sea bubble or 1929 or the tech bubble, you take a very good economic situation and you merely extrapolate it into the future. And if you do that, and it actually occurred, the market would be worth very high multiples of book and earnings and so on. It's a very simple game. Believe in today's perfect conditions and assume, unrealistically, as it turns out, that it will go on forever. If you did that today and you extrapolated today's conditions, which are miserable, you would, of course, have the very opposite of a bubble. So that makes it unique. We're in the highest 5% of PEs, and we're in the lowest 5% of economic conditions today. So there's never been anything like that in history. And why has it happened? We know the trouble is, of course, COVID, and we know the push on stock prices is a combination of central banks, the Federal Reserve, and fiscal spending. And it's global. So we have never had such a global agreement that every government is looking to spend and every government is looking for their central bank to accommodate. This is an enormous push. And what we discovered long ago is how effective that is at moving stock prices. It's as if every dollar that is not absorbed by the real world flows through line of least resistance, flows through into asset pricing. That is what is happening. It's a very impressive struggle between the real world of productivity and employment and GDP and the paper world of PE ratios and house prices pushed by easy credit, low interest rates, of course, being key, and just plentiful supplies of money flapping around to those people who are likely to buy houses and stocks. It is not necessarily the case at the small business level at all. So this is not necessarily terrific for the real broad economy, but it is clearly terrific for the stock market. And the question is, does the real world eventually catch up? And since this is novel economy, just like the novel virus, you can't be quite as certain as you could in prior bubbles. I described our confidence in prior bubbles as near certain. I wrote a paper called 3 Near Certainties for Uncertain Times. That was my title anyway, for Fortune in '08. All of those things, of course, occurred. And you can't be that certain this time because the forces are unique. That's going to make life more intellectually interesting. However, my bet would be, of course, that reality will catch up with the high PEs.
And expanding on that, part of what's happened is you have these weak economic conditions, no sign of inflation. And so it's a relatively easy playbook for central bankers across the world to cut interest rates, many of them are at zero or even below, and print money and keep providing stimulus to prop up the economies. And that could last for a while because inflation hasn't reared its ugly head yet. So how does that factor into how you invest in an environment like this, where there's a disconnect between economic conditions and markets as you described, but the cause of that, mostly central bank and fiscal policy, can continue for a long time? How do investors deal with this?
It's important to separate monetary from fiscal spending and FDR type broad-based planning of that kind. I'm a great believer in that. I'm much more suspicious of credit and interest rates. Let me just point out that we entered an era with Greenspan of a fairly decent kink in the cumulative debt curve. It had been drifting up very slowly and then it started to rise very rapidly since his era. What you notice is that despite the fact that the debt ratio per unit of GDP has doubled and tripled and will soon quadruple since the first day Greenspan, the growth rate of the US and the developed world has slowed. So if there was some easy relationship between debt and growth, it should have showed up. And in fact, the reverse has occurred. And that's one of the reasons I'm suspicious. As to the point when the market gets jumpy, very hard to read. If you go back to the earlier bubbles and you look at 1929, there was no great event. People have studied that now for 90 years, and we still haven't found the reason. The best we can come up with is, quote, selling came in from the country, unquote, which means it wasn't New York and Boston and the financial centers. It was the industrial centers of the Midwest. And they were the people who were seeing that the economy was weakening. And they looked at the high prices and the optimism that was everywhere and decided they would take some profits. And that was what turned the tide. And then more people decided they would take profits, and it spiraled out of control. It was not done by a massive change in the Federal Reserve policy or any government spending program. So that's what you have to be wary about, that in the end, high PEs are an intrinsically nervous and risky situation where everything is confidence. If you break confidence for any reason, it could be uniquely different this time. It has been quite different in each of the bubbles. But if you break confidence and you're way overpriced, you're looking at some very substantial declines.
I think one of the things that's interesting is when you look at valuation, and you look across the board, it seems like most asset classes are relatively expensive. And part of that is due to rates being at zero. And part of the central bank approach is to make cash as unattractive as possible and tell you they're going to keep it at zero for a long period of time to encourage you to spend the money, to invest it in something as a way to stimulate the economy. That could last for some time. You could have expensive markets becoming more expensive because you have this push that we haven't seen in a long time. And I'm just curious how you factor that in.
That is a possibility. But you can't get blood out of a stone. If you take a forest in New England, and I'm a great fan of forestry, and you back up 10 years, 12 years, you could get 6% return. And then you push up the asset prices across the board, and you come back 12 years later today, and the same forest will give you a 3% return. The same with the Midwestern farm. It's gone from 6% to 3%. Now, that's been a wonderful ride in capital gains, but the price you pay is you don't make 6% a year compounded, which is very handy, you make 3. And yes, if it goes up even higher, you'll make another capital gain, but the cost of that will be that the yield on the forest will go to 2. You get my point. So the price of staying high multiples is you get a low dividend, whether it's a farm or whether it's stocks. And that's what you see. So in the interim, you have this trade-off between lower yields on one side and capital gains on the other until it peaks out. And then you're left with lower yields and declining prices in the way we've experienced cycle after cycle since time immemorial.
You can either earn the returns now and suffer in the future, or you can postpone them until later, but over time, it's going to average out.
When you buy overpriced assets, you get a guarantee of a low return. What you don't get is the guarantee of being wiped out next week. But since you bring that topic up, my belief is that if you're trying to time the breaking of a bubble, the value is not that important. All of them are overpriced. And whether they're overpriced at 25 times earnings or 35 times earnings, or in Japan at 65 times earnings, it's very difficult to work out in any sort of academic way, since you're dealing with craziness, where it's going to peak. I much prefer to look for signs of truly crazy behavior, because every bubble that really crashed and broke in a spectacular way, which most of them did, was preceded by craziness, by legendary stories. This was notably lacking, as I wrote and talked about over the years of the 10-year bull market. It has not been lacking, really. I think you could agree in this rally off the COVID low. We have seen not only a terrific rate of acceleration in the price rise, double the normal bull market, which is characteristic. That acceleration is characteristic of the late stage bubble. But we've also seen wonderful craziness. The SPACs, which are a promise to use your money, give me your money and trust me, I'll do something useful with it. is a real echo of the South Sea bubble, where we have such a spectacular opportunity, we can't reveal what the purpose of your money is yet. And they got lots of money and ran off with it. I'm not saying the SPACs will run off with your money, but I am saying it's a real testimonial to the speculative nature. Buying Hertz, a bankrupt company, and having it go up 4, 5, 6 times in a real hurry, and so on and so on. You read about your own, having a Tesla quadruple this year. I own a Tesla. It's a wonderful car. I think they're a spectacularly interesting company. But are they 4 times the company they were before COVID? I don't think so. These stories are everywhere, and they're what you need before a bubble breaks. And we saw them in early 2000 and late 99. And we saw them in late 1929 before the crash. We saw them in Japan, and here we are again. So I think this is an indicator, not a certainty, but a strong possibility that we are quite close to the bubble breaking in terms of psychology. Perhaps a matter of weeks or months, not years.
What did you think of Jeremy Grantham's insights? What do you believe might happen when the bubble finally bursts? Give us your thoughts in the comment section down below. If you enjoyed this video, kindly like and subscribe, and we'll see you next time.